Have you ever wondered what leverage is in a business context? Well, let me tell you, it's not about lifting heavy objects. In business, leverage is a strategy that companies use to increase their potential returns. It's like using a lever to lift a heavy weight with less effort. In the context of business, this weight could be anything from launching a new product line to buying another company. There are three main types of leverage that businesses use: operating, financial, and combined. Operating leverage is all about the relationship between a company's fixed and variable costs. Financial leverage, on the other hand, is about using debt to fund business operations. Combined leverage is, as the name suggests, a combination of these two. Each of these has its own set of advantages and risks, which we will delve into in the following sections. So, are you ready? Let's dive in deeper to understand these types of leverage. First off, let's tackle operating leverage. Operating leverage, in its simplest form, is a measure that shows how a company's operating income reacts to changes in sales. It's a tool that helps us understand the relationship between fixed and variable costs in a company's operations. Think of fixed costs as those expenses that a business has to pay regardless of its level of production or sales: rent, salaries, insurance, and so forth. Variable costs, on the other hand, fluctuate based on the level of production or sales, like raw materials or direct labor costs. Operating leverage comes into play when a company has a high proportion of fixed costs in relation to variable costs. This means that when sales increase, a larger portion of each additional dollar of sales revenue goes toward profit because fixed costs remain the same. So a company with high operating leverage can see its profits soar with an increase in sales. But there's a flip side to this coin. When sales decrease, the company still has to cover its fixed costs. This can lead to a significant drop in profits or even losses. Therefore, high operating leverage can be a double-edged sword, bringing both higher profits in good times and greater risks in bad times. Let's consider a simple example. Imagine a company that manufactures widgets. It has high fixed costs due to expensive machinery and low variable costs as it buys raw materials in bulk. If the demand for widgets increases, the company can ramp up its production without significantly increasing its costs, leading to higher profits. But if demand dips, the company still has to pay for the machinery and may end up with unsold inventory, leading to potential losses. So that's operating leverage. It's all about the relationship between a firm's fixed and variable costs. Understanding this concept can give us valuable insights into a company's profitability and risk profile. Next, we move on to financial leverage. Let's delve into the concept of financial leverage. It's a strategy that involves using borrowed money or debt to finance a company's operations. The idea is to generate more income than what the firm has to pay in interest. Essentially, it amplifies the potential return of an investment. It's like a business playing with a magnifying glass, where the profit can be magnified, but so can the losses. For instance, suppose a company has $1 million of its own and borrows another million at an interest rate of 5%. Let's say the firm invests the total $2 million into a project that earns a return of 10%. The firm's profit after paying off the interest would be $50,000. This is a simplified illustration of how financial leverage can boost profits, but it's not always rainbows and butterflies. Financial leverage can also magnify losses. If the return on investment is less than the interest rate, the firm will suffer a loss. Using our previous example, if the project only returned 4%, the firm would lose $10,000 after paying off the interest. This is the risk of financial leverage. Moreover, an excessive amount of debt can lead to financial distress and bankruptcy if the firm is unable to meet its debt obligations. Therefore, a company needs to tread carefully when considering financial leverage. It's a double-edged sword. It can boost profits when times are good, but can lead to substantial losses when times are tough. In essence, financial leverage is about how a firm uses debt to finance its operations. It's a powerful tool that can help a company grow, but it must be used wisely. Like any tool, it's only as good as the hands that wield it. Be sure to understand the risks before diving into the deep end of financial leverage. Lastly, we have combined leverage. Combined leverage is a financial tool that companies use to assess their total risk. It's a measure that combines the effects of both operating leverage and financial leverage. In simpler terms, Combined leverage is like a two-in-one package that helps businesses understand the total impact of leverage on their profitability. Let's break it down a bit further. Operating leverage is all about how a company's operating costs are structured and how changes in sales volume can affect operating income. On the other hand, financial leverage pertains to how a company uses debt and equity to finance its operations and how changes in financial costs can affect net income. When these two are combined, we get combined leverage. It shows how a percentage change in sales can lead to a more significant percentage change in earnings before interest and taxes, and ultimately, the net income. It's like the domino effect. A small change can trigger a series of changes leading to a substantial impact. Now, let's consider an example. Imagine a company named Techies. Techies has high operating leverage because it has significant fixed costs for research and development. It also has high financial leverage because it borrowed heavily to finance its operations. If Techies' sales increase by 10%, this increase will have a magnified effect on its operating income due to its high operating leverage. The high financial leverage will further amplify this increase, leading to a significantly higher net income. However, it's essential to remember that while high combined leverage can lead to higher profits when sales are increasing, it can also lead to substantial losses when sales are declining. It's a double-edged sword. Therefore, companies must manage their combined leverage effectively to balance the potential rewards with the associated risks. It involves a careful analysis of the company's cost structure, financing decisions, and sales forecasts. Combined leverage, then, is a measure of how operating and financial leverage can amplify the effects of changes in sales on a firm's earnings. Now that we've covered all three types of leverage, let's recap. We started with operating leverage, which, if you recall, is all about how a company uses its fixed and variable costs. It's a measure of how sensitive a company's operating income is to its variable costs. When a company has high operating leverage, it means that it has a larger proportion of fixed costs and a smaller proportion of variable costs. This can lead to greater profits as sales increase, but it can also lead to greater losses if sales decline. Next, we delved into financial leverage, which focuses on how a company finances its assets through debt or equity. A company with high financial leverage has a large amount of debt relative to equity. This can magnify the company's earnings per share and return on equity if things go well. But remember, it can also magnify losses if things go south. Finally, we explored combined leverage, which, as the name suggests, is a combination of both operating and financial leverage. It provides a broader perspective of a company's risk and return potential. The higher the combined leverage, the higher the risk, but also the higher the potential return. Understanding and managing these three types of leverage is crucial in a business context. They each have their own benefits and risks, and knowing how to use them to your advantage can make a big difference in a company's financial performance. Remember, the key is balance. Too much operating leverage can make a company vulnerable to fluctuations in sales. Too much financial leverage can make a company vulnerable to fluctuations in interest rates and debt repayments. And too much combined leverage can make a company vulnerable to both. Remember, leverage is a powerful tool, but like all tools, it must be used wisely. Over-leverage can lead to financial distress, while under-leverage can result in missed growth opportunities. So, keep these concepts in mind as you navigate the world of business and finance. We've covered a lot today, but I hope you now have a better understanding of what leverage is and how it works in a business context. From exploring the intricacies of operating leverage and its impact on business profitability, to delving into the world of financial leverage and its role in enhancing returns or magnifying losses, we've taken quite a journey. And let's not forget our exploration of combined leverage, a powerful tool that blends both operating and financial leverage for maximum impact. But don't let your learning journey stop here. There's so much more to discover about these concepts and how they apply in real-world scenarios. Each business, each industry, and each market may use these forms of leverage differently, so keep exploring, keep asking questions, and keep expanding your understanding. Thanks for watching. If you found this video helpful, don't forget to like, share, and subscribe for more informative content like this. Until next time, keep learning and stay curious.